Did you know that 90% of Fortune 500 companies have a secret insurance strategy that's making them millions while you're literally throwing money away every single year? And the crazy part is that it's completely legal, endorsed by the IRS, and has been hiding in plain sight since 1953. Here's the problem that every business owner like you faces. You're spending massive amounts on insurance premiums, money that disappears forever unless you have a claim. For the average business, that's 2 to 5% of your total revenue every year just gone. Poof, gone, see ya, sayonara, toodaloo, do not pass go, do not collect $200. But what if I told you that Disney, Microsoft, Amazon, and virtually every other major company that you respect isn't just buying insurance, they're selling it to themselves through something called captive insurance companies. Now, this isn't some tax loophole or sketchy offshore scheme. It's a legitimate business strategy that transforms a pure expense into what might be the most powerful wealth building vehicle you've never heard of. Today, I'm showing you exactly how this works and why it might be the single most important financial move you could make this decade. What's up, everyone? I'm Kev Legend, wealth strategist, lifestyle architect, and founder of Rowan Games. And if we're just meeting, I spent 10 years as a naval officer before becoming obsessed with one question. Why do some businesses generate wealth that lasts for generations, while others with similar revenue barely survive after taxes and expenses? The answer led me to study how the ultra-wealthy structure their affairs differently, not just what they invest in, but how they fundamentally approach business costs that most people accept as unavoidable. After implementing these strategies with clients around the world, I've seen firsthand how something as boring as insurance can become an incredible wealth-building machine when structured correctly. We're talking about transformations where 1 million annual expenses can become a $10 million asset in a decade. Welcome to the Legend Lab, where I break down these exact strategies in plain English, covering the same information that would cost you $25,000 or more in consulting fees if we work together directly. If you're ready to see how the truly sophisticated protect and build wealth, tap that like button because here we go. In the next 20 minutes or so, I'm going to completely change how you think about business insurance forever. Here's what we're covering. First, I'll expose the fundamental wealth draining problem with insurance that's costing you thousands, maybe millions a year. Second, I'm breaking down what a captive insurance company actually is and why it transforms a pure expense into a wealth building asset. Third, we'll explore the hidden benefits beyond just recapturing premiums, including powerful asset protection, incredible investment flexibility, and tax advantages that make traditional retirement accounts look primitive by comparison. Fourth, I'll reveal the specific types of businesses that benefit most from this strategy because contrary to what most advisors will tell you, you don't need to be a Fortune 500 company to implement this approach. And finally, I'll show you the exact steps to determine if the strategy is right for you, including the minimum thresholds and first moves to make if you decide to explore this further. But here's what makes this urgent. Insurance premiums across virtually every industry have increased by double digits in the last 24 months, with some sectors facing 25% plus jumps. And this trend isn't slowing down, which means the wealth draining problem I'm about to expose is getting worse for businesses by the day. So let me ask you, if your insurances are going to increase regardless, wouldn't you rather those increases go into an asset you own instead of just disappearing forever? This leads me to strategy one. The first strategy that separates how the ultra wealthy handle insurance from everyone else is what I call the expense to asset conversion system. And I need you to understand something crucial. This completely flips the traditional insurance model on its head. Think about how normal insurance works. You pay premiums, and in exchange, you get coverage for potential losses. Not rocket science, but it's also not lovely. The best case scenario, nothing happens and your money is gone forever. Worst case, you have a claim, which means something bad happened to your business. There's literally no winning scenario where your money comes back to you. Kind of sucks. That's the equivalent of renting a house for decades and pouring money into an asset you'll never own. The ultra wealthy, they're building the house and paying themselves the rent. Here's the sobering math. If your business has been operating for 10 years and you've been paying $500,000 annually in insurance premiums with minimal claims, you essentially gifted the insurance company $5 million. That's not just the cost of doing business, that's a massive wealth transfer that could have stayed in your financial ecosystem. Let me share you a real world example. Berkshire Hathaway, Warren Buffett's company, my boy, Warren, has built an empire largely on insurance operations. Why? Because he understands that collecting and investing premiums is infinitely more profitable than paying them. But here's what should really blow your mind. According to AM's Best Captive Insurance Report, the average captive insurance company maintains a combined ratio of 12 to 15% better than commercial insurers. That means for every 1 million in premiums, they're generating 120 to 150,000 more in underwriting profit than the big insurance companies. Over 10 years, that's a $1.2 to $1.5 million advantage. On top of keeping the premiums you'd otherwise be sending away forever. Here's exactly how the expense to asset conversion system works. First, you establish a legally separate, properly capitalized insurance company that meets all the regulatory requirements, all of them. This isn't a self-insurance fund or a reserve. It's actually a licensed insurer. You heard? Second, your operating business pays actuarially determined premiums to this captive for specific, legitimate coverage, just like you'd pay any commercial insurer. Third, these premiums now build up in your captive, which holds them as reserves against future claims while investing them for additional returns. Fourth, when a claim occurs, they're paid from these reserves, but with proper risk management, a significant portion of these premiums ultimately becomes profit within the captive structure. The eye-opening part? This isn't some obscure loophole. Harvard Business School professor Michael Porter identified this as a core strategy in his landmark research on competitive advantage decades ago. And we all love a competitive advantage. Your competitors are likely still pouring millions into commercial insurance, while the sophisticated players in your industry have already implemented variations of this approach. But I'll be completely transparent. This strategy isn't for everyone. You need meaningful insurance premiums, typically anywhere from $500,000 or more annually. And that's just to justify the setup and the operational costs. And you need legitimate insurable risks, not manufactured ones. And you need proper implementation with qualified professionals who understand both insurance regulations and strategic wealth planning. Okay, if you're starting to see how transformational it could be to convert a pure expense into an asset you control, hit that like button, because this perspective shift alone could create a multi-million-dollar impact on your business over the next decade.
Now, before we dive into where the ultra-wealthy actually establish these insurance companies, I need to share something personal with you. Because honestly, most of you watching this probably think starting an insurance company is way beyond your reach. And 5 years ago, I would have agreed with you. Look, I was the CEO of a $1 million financial advisory firm, managing over $100 million in client assets with a team of 12 advisors. I had the corner office, the 7-figure income, multiple properties across the US, everything that looked like success from the outside. But here's what was eating at me. I was burnt out, working insane hours, and not doing what I actually loved, which was educating people about these sophisticated wealth strategies. That was my genius zone, the thing that took me from being a poor kid from Jersey to understanding how the ultra wealthy really operate. Then I had a realization that changed everything. These captive insurance strategies, these wealth building techniques I'm sharing with you today, and others that I share in the Legend Lab, they shouldn't be locked away for people who already have $100 million. The principles behind controlling your financial systems, building generational wealth, thinking like an owner instead of a customer, these concepts can be adapted for any serious business owner. So I walked away from the advisory firm, from the traditional model, from everything, because I knew I could help way more people by democratizing this financial intelligence instead of just serving ultra wealthy clients. That's why I created the Legend Lab, to break the financial industry and teach ambitious business owners, entrepreneurs, and high-earning professionals to build their own financial empires. You might not be ready to start an insurance company tomorrow, but you can absolutely learn to think like the people who do. If you want to understand these wealth building principles and how they apply to your situation, whether you're doing 100K or 50 million in revenue, check the links below or head to mylegendlab.com, because the financial revolution starts with understanding how the game really works at every level. All right.
Strategy 2, the strategic jurisdiction advantage. Now that you understand the core concept, let's talk about where the ultra wealthy actually establish their captive insurance companies and why location matters more than people realize. Doesn't location always matter? And it's the difference between a captive that struggles under regulatory burden and one that operates with maximum efficiency. Here's a shocking statistic. According to Marsh's Global Captive Report, over 80% of Fortune 500 captives are domiciled in just 6 jurisdictions globally. This isn't random. It's strategic selection based on specific regulatory and operational advantages. Think about it like real estate. Location always matters. Location, location, location. If you were opening up a retail store, you wouldn't just pick any random building. You'd consider foot traffic, local regulations, operating costs, and dozens of other factors. That same principle applies to captive insurance, but with significantly higher financial stakes. The ultra-wealthy are incredibly selective about where they establish their captive, focusing on jurisdictions that offer 3 critical advantages. First, regulatory efficiency. Certain domiciles have developed sophisticated but streamlined frameworks specifically designed for captive insurance. They understand the industry and create environments where these structures can operate effectively without unnecessary bureaucracy. Second, capital efficiency. Some jurisdictions require substantially lower initial capital than others. For example, Vermont might require $250,000 in initial capital, while certain offshore domiciles may require only $100,000 for the same coverage lines. Third, specialized expertise. The leading captive domiciles have developed entire ecosystems of managers, directors, actuaries, and administrators who understand these operations intimately. When you establish a captive in these locations, you're not pioneering new ground, you're plugging into decades of specialized experience. According to the latest captive domicile rankings, Vermont leads in the US with over 600 captive licenses, while Bermuda, the Cayman Islands, and Luxembourg dominate the international landscapes with over 600 captives each. I advised the tech company CEO, let's call her Sarah, who initially planned to establish her captive in her home state. After analyzing the regulatory requirements, capital demands, and available expertise, we decided on Vermont. This single decision reduced her initial capital requirement by $200,000 and gave her access to a regulator who specialized in her specific industry's risk profile. But here's the part nobody talks about. The jurisdiction selection isn't just about initial setup, it's about long-term operational advantages. According to Captive Insurance Times survey, captives in optimal jurisdictions reported 23% lower operational costs and 18% better investment flexibility. Now I know what some of you are thinking. Offshore sounds sketchy as, but let me be crystal clear. The primary advantages of strategic jurisdiction selection aren't tax related. They're regulatory and operational. This is about finding the most efficient and expert environment for your legitimate insurance operation, not about hiding or evading anything. In fact, according to the IRS's own guidance, properly structured captives in any jurisdiction must have legitimate insurance purpose, appropriate capitalization, and genuine risk distribution to receive favorable tax treatment. The location itself doesn't change these core requirements, but I should address the risks too. Not all jurisdictions are created equal. Some have earned poor reputations due to inadequate oversight or problematic structures. That's why serious captive owners focus on established, respected domiciles with strong regulatory frameworks, not obscure locations offering suspiciously loose standards. So, if you're beginning to see why strategic jurisdiction selection might be just as important as the captive structure itself, hit that like button, because this often overlooked aspect can dramatically impact the long-term success of your captive strategy. That brings me to strategy 3, the comprehensive risk response system. Let's move beyond the financial aspects to something equally powerful, the ability to insure risks that commercial carriers either won't cover or charge exorbitant premiums to address. This is the comprehensive risk response system, and it's revolutionizing how sophisticated businesses approach their unique risk profiles. Here's a reality that should concern every business owner. According to the industry surveys, the average commercial insurance policy contains over 40 coverage exclusions, specific scenarios where you won't be protected despite paying all the premiums. Even worse, as markets harden, carriers are adding more exclusions while simultaneously raising rates. Think about the most dangerous risks about your business. Are they the standard generic threats that every business in America deals with? Or are they unique to your industry, your business model, your geographical location, or your specific operations? For most businesses, the most severe risks are precisely the ones that commercial carriers either exclude entirely or drastically overcharge to cover. This is where captive insurance creates what might be the most overlooked advantage, the ability to custom design your actual risk profile. According to Risk and Insurance Management Society research, businesses with captives report 37% greater satisfaction with their overall risk management outcomes compared to those relying solely on commercial coverage. This isn't just about saving money, which is great. It's about genuinely superior protection. The comprehensive risk response system works through a 4-phase process. First, detailed risk assessment, identifying your actual exposures, not just the standard list that commercial policies address. Second, customized policy design, creating insurance language specifically tailored to your unique risk profile without standard exclusions that leave you vulnerable. Third, actuarial pricing, determining appropriate premiums for these custom coverages based on your specific loss history and risk management policies. Fourth, ongoing optimization, using claims data and emerging risks to continuously refine both your coverage and your operational risk management. Because in today's increasingly volatile business environment, this customized protection might be even more valuable than the financial benefits we've discussed. That brings me to strategy 4, the investment acceleration framework. Now we're getting into what might be the most financially powerful aspect of captive insurance, what I call the investment acceleration framework. Most business owners completely miss this. Insurance companies don't just collect premiums and pay claims. They invest the float, which is the premiums held before the claims occur. And this creates what Warren Buffett had described as free money that can compound for decades. Anybody want some free money? Here's the astonishing reality. According to insurance industry data, the largest commercial insurers earn over 40% of their profits, not from underwriting, but from the investment returns on premium dollars they're holding on to. When you pay premiums to commercial insurers, they invest that money for their benefit until a claim occurs. With a captive, you do the same, but for yourself. But here's where it gets truly game-changing. Insurance companies have special investment privileges and flexibility that other businesses aren't able to enjoy. I advise a successful business owner, let's call him Pat, who is particularly frustrated by how little of his business profits he could invest for growth after paying taxes. Through his captive, he was able to build a multi-million-dollar investment portfolio using pre-tax premium dollars, creating what amounted to a massively expanded retirement plan without the typical contribution limits. This investment acceleration framework works through 4 key mechanisms. First, premium retention. Unlike money spent on commercial insurance, premiums paid to your captive remain within your financial ecosystem. Second, tax advantage investing. Depending on the structure, premiums received can often be partially deductible to the operating business, while not immediately taxable to the captive, creating a timing advantage for investment growth. Third, expanded investment options. Insurance companies have broader investment flexibility than typical qualified retirement plans, allowing for potentially higher returns. Fourth, compounded growth. As investment returns accumulate within the captive, they generate additional investment capacity, creating a powerful compounding effect over time. According to Milliman actuarial studies, a well-managed captive's investment returns can add 2 to 4% annually to the overall return on premium dollars, compared to what those same funds would generate in a typical corporate account. Now, that might not sound dramatic until you see the compounding effect. For a business putting $1 million annually into a captive, this 2 to 4% additional return could generate $2.5 to $5 million in extra wealth over a 10-year period, purely from the investment advantage, which is separate from the underwriting benefits. But here's the critical nuance here. Investment strategy must be aligned with the captive's claims profile and the reserve requirements. This isn't about aggressive speculation with insurance reserves. It's about optimized, strategic investing appropriate for an insurance operation. The ultra-wealthy understand something profound. Captive insurance isn't just about risk management or tax efficiency. It's about creating an alternative wealth accumulation vehicle with unique advantages unavailable to other structures. And what's particularly powerful is that it creates this forced savings structure for business owners. Rather than showing higher taxable profits that might be distributed and spent, the captive systematically builds a growing pool of assets that can later fund business expansion, acquisitions, or generational wealth transfer. Now, I want to address something important. You might be wondering if all of this is too good to be true. The reality is that captive insurance is neither a miracle nor a scheme. It's a sophisticated business structure that, when properly implemented for the right reasons, creates significant advantages over traditional approaches to both insurance and wealth accumulation. If you're beginning to see how transformative it could be to not just recapture insurance premiums, but to supercharge their growth through strategic investing, tap that like button, because this compounding effect over decades is how captive insurance truly builds generational wealth. And of course, I saved the most important strategy for last, what I call the legitimate implementation framework. Because everything I've shared so far only works when your captive is properly structured, professionally managed, and fully compliant with all regulatory requirements. Let me be direct. The IRS has specifically identified certain captive arrangements as audit priorities. particularly those that appear to be tax-driven rather than focused on legitimate risk management. This scrutiny has intensified significantly over the last 5 years. According to IRS data, improperly structured captives face audit rates up to 50 times higher than properly implemented ones. But here's what terrifies me. I regularly meet business owners who have been sold captive structures by promoters emphasizing tax benefits while glossing over the critical insurance substance requirements. These arrangements inevitably face costly audits, penalties, and potential recharacterization of what should have been legal and legitimate structures. The legitimate implementation framework has 5 non-negotiable elements that separate sustainable captives from problematic ones. First, genuine risk transfer and distribution. Your captive must involve actual shifting of risk from the operating business to the insurance entity, with appropriate distribution of risk, either through third-party insurance or multiple insured entities. Second, actuarially sound premiums. The amount charged must be commercially reasonable based on professional actuarial analysis, not inflated to maximize deductions or minimize taxes. Third, proper capitalization and reserves. Your captive must maintain appropriate capital levels and loss reserves as required by insurance regulations, not minimum amounts designed solely to limit investment. Fourth, legitimate insurance operations, including formal underwriting procedures, claims handling processes, regulatory compliance, and independent management. Fifth, thorough documentation. Thorough, which means maintaining comprehensive records that clearly establish the business purpose, risk management objectives, and operational substance of the captive. Okay, so here's what I'm thinking. If someone is selling you a captive primarily as a tax strategy rather than a risk management tool with additional financial benefits, walk away immediately. The tax advantages of captive insurance are real, but they must flow from legitimate insurance operations, not drive the entire structure. The implementation process typically takes 6 months, maybe a little bit more, and involves multiple professional disciplines: captive managers, actuaries, attorneys specializing in insurance law, and accountants with specific captive expertise. This is sophisticated planning that requires a qualified team, not a one-size-fits-all solution. And I want to be crystal clear about something. The most successful captives are those established for the right reasons: superior risk management, coverage customization, cost control, and long-term financial efficiency. Tax benefits are the natural result of a properly structured captive, not its primary purpose. Okay, let me wrap this up with a reality check that might sting a little. While you've been faithfully writing checks to the insurance companies year after year, watching those premium dollars disappear forever, the ultra-wealthy have been capturing those same payments in structures they own and control. And they're not taking crazy risks or exploiting loopholes. They're simply using a legitimate business strategy that's been hiding in plain sight for decades. I want you to think about something. If you've been in business for 10 or more years, how much have you spent on insurance over that time? $1 million? $5 million? More? Now imagine if a significant portion of that money was still in your financial ecosystem, growing and compounding, rather than enriching insurance companies' shareholders. Pretty cute, right? That's not fantasy. It's exactly what captive insurance makes possible for businesses that meet the right criteria. Okay, let's recap the 5 strategies that we covered. Strategy 1, the expense to asset conversion system, which is transforming insurance from a pure expense into a wealth-building asset you control. Strategy 2, the strategic jurisdiction advantage, which is selecting the optimal regulatory environment for maximum operational efficiency. Strategy 3, the comprehensive risk response system, which is custom designing coverage around your actual business risks, rather than accepting generic policies with dangerous exclusions. Strategy 4, the investment acceleration framework, which is capturing the investment value of premium dollars that commercial insurers would otherwise keep for themselves. Strategy 5, the legitimate implementation framework, which is ensuring your captive has proper substance, documentation, and compliance to withstand regulatory scrutiny. Here is the brutal truth. The insurance industry isn't designed to maximize value for its policyholders. I love insurance, but I had to say it. It's designed to maximize profit for its carriers. By implementing a captive strategy, you're essentially moving the profitable side of that equation without sacrificing the protection. Ooh, I love an equation analogy. According to AM Best, the property and casualty insurance industry generated over $970 billion in premiums in the past year, while paying out only $600 billion in claims. Now let's do the math, because the math is mathing. That is $370 billion difference that isn't just covering overhead. It's creating massive shareholder value that could be floating to your bottom line instead. The question isn't whether these strategies work. They clearly do, by evidence of successful captives operating worldwide. The question is whether they're appropriate for your specific situation and whether you'll implement them before rising commercial insurance costs erode even more of your profits.
If you're ready to start thinking like the ultra wealthy instead of just learning about them, here are your next steps. Step 1. Start with the foundations at the Legend Lab. This is my complete financial education platform where I teach the core principles behind every strategy we covered today. You can't implement captive insurance if you don't understand wealth architectural fundamentals.
But you gotta make sure you're subscribed so you don't miss it.
Step 2. Join the Legend Lab community and access the Wealth Jungle. This is our complete prompt library that transforms any AI into your personal wealth strategist. Whether you're analyzing insurance costs, investment opportunities, or business decisions, these prompts give you professional grade analysis instantly. Step 3. Get direct implementation support. For those ready to take serious action, whether it's working on building a $1 million mindset or taking the next steps toward financial sovereignty, we meet you where you're at and offer coaching where me and my team help you optimize your current financial situation and mentor you down a pathway to business, financial, or individual success you know you deserve. Here's the thing. The captive insurance strategies we covered today are advanced implementations of wealth building principles, but those principles work at every level. You just need to know how to apply them to your situation. Everything you need is at mylegendlab.com or in the links below.
Remember, in a world where business owner costs continue to rise exponentially while coverage narrows, captive insurance isn't just a clear strategy, it's increasingly becoming a competitive necessity for businesses that want to thrive long term. I'm Kev Legend, thanks for watching, and I'll see you in the next one.